Good morning, everyone, and thank you for joining us today on our webinar that's part of our digital asset series. Today, we're going to be talking about tax considerations on digital assets, and more specifically from a South African landscape tax perspective. I am Dilem Pillay, and I'm a director in our risk advisory department, and I'm joined today by Oze Ahmed, who is a director in our corporate tax department. So as you know that, from a South African perspective, digital assets, more specifically sort of cryptocurrencies and cryptocurrency tradings, is not necessarily regarded as sort of legal tender. What it is regarded as is actually more on the digital asset side, which means it's looked at your gains and your losses is looking at its increase and decrease in value. It's looking at disposals of those particular assets. So what we thought of is let's look at some key considerations from a South African perspective as far as taxation of those particular triggers are concerned. Now, from a South African standpoint, our legislation is, I think, still gearing up to be able to address all the various types of digital asset type of transactions, be it cryptocurrency trading, be it trading in NFTs, etc. But let's just talk a little bit about where we are right now. So Oz, over to you. Can we maybe just discuss a little bit about where do we see ourselves from a South African landscape perspective in terms of taxation on digital assets?
Great. No, thanks, Dilem. I think, like you mentioned, and perhaps the first thing to mention is that, cryptocurrencies and crypto assets are not considered legal tender in South Africa. So this doesn't mean that it cannot be offered or accepted as a means of payment, and individuals may therefore choose to accept payment offered in crypto assets of their own free will. But they have to have the understanding and acceptance of the risk that they will not have any regulatory recourse for payment perspective should something go wrong. So when considering the taxation of crypto assets, there's no specific sections within the tax legislation that deal with the taxation of tax treatment of cryptocurrencies and digital assets, right? All that is included in Section 1 of the Income Tax Act is the term crypto asset, which is included in the definition of a financial instrument in Section 1, like I mentioned. So while the term crypto asset is not defined any further in the Income Tax Act, SARS have a definition of crypto assets on their website. And just bear with me, they define it as follows. It's a digital representation of value that is not issued by a central bank, but is traded, transferred, and stored electronically by natural and legal persons for the purpose of payment, investment, and other forms of utility, and applies cryptography techniques in the underlying technology. So you can see that it's quite a broad and quite a vast definition. So one thing on this point, it would seem that the use of the term crypto asset and not cryptocurrency, which was the previous term included in the definition of a financial instrument, is intentional. SARS have indicated that the word cryptocurrency was replaced with crypto asset in line with this proposed framework or adoption of a unique definition of crypto assets, right? Another view is that currency is excluded from the CGT net. And the term crypto asset and not cryptocurrency will therefore bring the tax treatment of crypto assets as a whole into the CGT net. Then another point worth mentioning is that, in the definition of crypto asset, they use the phrase applies cryptography within the definition, which would seem to give quite a broad meaning again, and would therefore look to include anything associated with blockchain and cryptography. Looking into the future, perhaps SARS already has, one eye on the metaverse and all that will go with it. So SARS have not issued any guides or interpretation notes specific to crypto assets, and SARS guidance on the tax treatment of crypto assets is actually limited to a page on their website and a list of FAQs. It is here where SARS state that transaction or speculation in crypto assets is subject to the general principles of South African law and tax accordingly. So what does this mean? This implies that depending on the circumstances of an individual and intention of each individual taxpayer, income received or accrued from crypto assets, transactions can be taxed either on revenue account under gross income. Alternatively, such gains may be regarded as capital in nature and taxed under the CGT regime. SARS had mentioned that the determination of whether an accrual is a receipt for revenue or capital in nature is tested under existing jurisprudence, which is basically the existing case law.
Also, I think the you know the gearing towards looking at it from and defining it in sort of a bucket of crypto assets as opposed to cryptocurrencies is, as you've indicated, sitting on essentially the blockchain. Now, cryptocurrencies is only one type of digital asset that is essentially a product of a blockchain. And we'll talk a little bit about NFTs and the tax on that a little bit later, but NFTs is another type of digital asset. And those types of digital assets are going to sort of keep evolving. So obviously they're looking forward to the various products that's going to be coming off this sort of cryptography type of platform. Because, in terms of, cryptocurrencies versus NFTs, aside from being built on the blockchain and being subject to the very similar cryptography protocols, that's essentially where the similarity ends in terms of those digital assets. Aside from it being a digital asset and being increasing in exceptionally volatile in its value. But I think for sort of, people listening into this webinar, maybe we can just talk through some of the type of taxable events that we're seeing taking place in terms of cryptocurrency trading, also from possibly, and we'll go on to that from an NFT standpoint, just so that individuals can maybe understand what could be considered a potential taxable event that is going to result in, obviously disclosure and sort of tax thereof.
Yeah, sure. And like you say, digital assets or crypto assets, as SARS refers to, you've got your cryptocurrencies, which most of us are probably involved in or have some sort of knowledge of, and you get the other digital assets like your NFTs and where the games are played on blockchain, etc. So maybe perhaps let's look at the taxation of cryptocurrencies as a starting point. So on this slide, we've just listed some of the more common taxable events that result from cryptocurrency transactions or trade. Just bear in mind that the Act refers to crypto assets and not only cryptocurrencies. So the first one we're talking about is trading cryptocurrencies worth of a fiat currency. So that's the scenario where, the sale of cryptocurrencies, you're translating your cryptocurrencies like Bitcoin into ZAR or dollars. So maybe one of the first things to consider is how would the cost of the cryptocurrency be sold or determined. So bear in mind that cryptocurrency is not considered a share. So one cannot use the average or weighted average cost to determine the cost of your cryptocurrencies. So the most applicable or the most reasonable way to consider this is probably the first in, first out method, or the Fifo method. So maybe let's try by way of example, right? And just bear with me if you can just remember what I'm trying to say. So in year one, a person buys one Bitcoin for say 1,000 Rand. In year two, a person buys another Bitcoin for 2,000 Rand. In year three, a person sells it one Bitcoin for 3,000 Rand. So by applying the Fifo method, the cost on the sale will be the 1,000 Rand, which is basically the first Bitcoin a person purchased, and therefore he will realize 2,000 Rand profit. Depending on the circumstances, either added to taxable income as revenue or taxed as a capital gain. The second common scenario is we have trading one type of cryptocurrency for another. So a person will have Bitcoin and he'll exchange it or trade it for, say, Ethereum. Again, let's use a simple example here. In year one, I buy one Bitcoin for 1,000 Rand. In year two, I sell my one Bitcoin for one Ethereum, and the market value of Ethereum is, say, 4,000 Rand. So the proceeds will therefore be the market value of the Ethereum gained, which is the 4,000 Rand, less the cost of the Bitcoin purchase. So in this scenario, the profit or gain will be 3,000 Rand. So the sale of the Bitcoin is the taxable event and not the purchase of the Ethereum. Then, spending of cryptocurrencies on goods or services, because like we mentioned earlier, it's not legal tender, but a person can use their Bitcoin or cryptocurrencies to procure services, to procure goods. And in that, there's a taxable event as well, because remember, if you're giving someone a Bitcoin as a means of payment, you are disposing of that Bitcoin, and that would lead to a taxable event. Another common item which is here is earning of cryptocurrency through mining. And technically, look, Alan, I think you're more familiar with the technical terms and definitions of all these concepts, but I'm going to give it a shot. So technically, mining is conducted by the verification of transactions in a computer-generated ledger, achieved through the solving of complex computer algorithms. And from my understanding, in simple terms, a person will be rewarded with cryptocurrency for solving these algorithms, right?
Spot on.
And again, sorry?
Spot on. That's exactly what it is.
Okay, great. Okay, and I've got something a bit more here for you. So correct me again if I'm wrong. But mining uses quite a bit of computer power. I mean, I've seen pictures of massive graphic cards and guys, reusing them, etc., which in turn then consumes a significant amount of electricity. So I'm just thinking with our power crisis at the moment, I don't know if people are actually really doing a lot of mining in South Africa. But anyway. So if we look at applying the principles of gross income to mining, right? So mining can be seen as earning income through a course of a scheme of profit making. And in all likelihood, income earned from mining will be taxed as a revenue item. Quite a common concept, and most people within the tax space will understand that concept. Then there are, however, two components of taxable events to consider with respect to mining. So if a person mines and receives 1 Bitcoin, then the market value of the Bitcoin at the date of receipt will be added to a person's taxable income. Secondly, when the mined Bitcoin is then sold, this will then trigger another taxable event. So for example, when a person received 1 Bitcoin when mined, the Bitcoin had a market value of 1,000 Rand, which would have been added to that person's taxable income at the time of receipt. If a person subsequently sells that mined Bitcoin at a later date, when the market value is say 3,000 Rand, then that person will realize a 2,000 Rand profit, which will be added to taxable income or taxed as a capital gain, depending on the circumstances. Yeah, so that's kind of the mining.
But just on the mining side, though, I mean, as you mentioned, you're looking at it more from a gross income perspective, which means there's a whole lot of costs that would be, I would assume, be taken into consideration in terms of establishing tax deductible costs against that gross income, and that's looking at the various types of infrastructure that you would need to purchase, potentially your energy bills, etc., that's actually used in the generation of that income.
Yeah, I know, 100% spot on. So while crypto assets are subject to the general principle of South African tax law and taxed accordingly, in applying those general principles, a person would qualify for deduction against any expenses associated with the purchase of cryptocurrencies. Alternatively, the costs incurred would form the base cost of the cryptocurrency or digital assets. In this way, a person's taxable income will obviously be reduced by the costs incurred. So, in terms of mining, like you said, in all probability, the infrastructure, those graphics cards, those sophisticated computer systems might form a capital asset, and we might be able to claim depreciation on it. That would be probably the most appropriate way to look at it. Like you say, other costs incurred, like your energy bills, those are probably direct tax deductible expenses. And the same goes for the other types of on all other assets as well. All costs associated will be and should be allowed as a deduction.
But I think that the record keeping there is going to be quite important in order to sort of claim those costs back, because if you were to claim them back, I mean, it's going to trigger obviously a request for additional supporting documentation when you try to do that via your tax return. So it's just like a lot of these individuals and these miners are essentially having it possibly as a hobby or just as sort of a sideline business. Sometimes they're using their existing home type infrastructure, so it's almost sort of a like work from home type record keeping that you would really need to keep quite a detailed record of to sort of appropriate and allocate, especially shared expenses that is not incurred solely for the mining purposes.
100%, Alain. You hit the nail on the head, and we'll come to this a bit later. The burden of proof or being able to prove your expenditure or income is on the taxpayer. And we'll come to this again, I say a bit later. I think going forward for SARS or any revenue authority to identify, the income generated from a person will be quite easy. I foresee that will be quite simple going forward. But like you say, the expenditure, the taxpayer is going to have to keep accurate records, and that's going to be able to prove that, so much of my energy bill went into mining, as opposed to, like you say, you're sitting at home and you're doing it as a hobby. How much of that energy bill is used, I don't know, just to run your home, as opposed to that specific mining operation. So yes, you're going to have to use, you're going to have to consult someone to see how you actually apportion those expenses and keep correct, accurate records.
And then I think just you mentioned a bit earlier when you're talking about, obviously the trading of cryptocurrencies and the trigger events there, which is obviously at disposal generally, and a disposal it takes various forms. But when would it be between decided whether it goes into gross income versus CGT? Because the tax rates there are quite different.
No, definitely 100%. Look, you're going to have to look at each individual taxpayer according to his circumstances. Generally, you're going to look at how often a person trades, for example. That frequency of trades is a common thing revenue authorities will look at. Is a person doing it, is a once-off event? Is he doing it every day? Is he earning a living from it? Is it a hobby? So all those different circumstances will be taken into account. Take, for example, mining. How much expenditure has a person, incurred to set up his infrastructure? That will be kind of indicative of a person, carrying this on as a trade. I mean, he's spending thousands, hundreds of thousands of rand on graphics cards and other hardware and software. Maybe he's looking at, generally people won't do that as a hobby. It be probably someone a bit more serious. So, circumstances will vary. If SARS audits you, you're going to have to prove your circumstances, what exactly you were doing at the point in time. We know what I mentioned earlier, that it's not considered a share, and that's quite specific because in terms of the legislation, if you hold share for a certain amount of time, then it's regarded as capital. I think something like 3 years. If you hold on to a share, then it's regarded as capital in nature. But if you're doing, free selling or buying shares all the time, then obviously you're going to find yourself in the revenue net. So definitely each taxpayer is going to find himself in a different scenario, different circumstances. Ultimately, you as the taxpayer, you have to just discharge the burden of proof and be able to support your stance.
I suppose the important thing is that if you're unclear, maybe it might be worth seeking some professional advice, because you do not want to be disclosing under the incorrect sort of maybe line items from a tax return perspective. So just going into some of the other taxable events, such as staking, which is now sort of garnering a lot more interest and functionality, especially with people purchasing sort of cryptocurrencies. The cryptocurrency is taking a huge dip, so they're just going to hang on to it until they possibly recoup its initial purchase value, possibly, or generate just a little bit of profit. So a lot of individuals are essentially just sort of staking those either for rewards or staking it from an interest perspective. So let's talk a little bit about the taxing aspects from a staking perspective.
Yeah, another technical aspect, and I'm going to put it simply, and I think I'm going to be oversimplifying it. Staking is a way of earning rewards for holding or locking up certain cryptocurrencies, And similar to mining, a person will earn cryptocurrency for staking or proof of stake. And this would probably be taxed in the same way as mining. Interestingly enough, there's a case on the go in the US at the moment where the plaintiffs, their names are Joshua and Jessica Jarrett. And they are the validators on the Tezos blockchain platform. And Man United supporters and McLaren supporters will know Tezos because they're their sponsors. But anyway, they received a staking reward and declared it as income, and they paid the relevant tax on it. They subsequently decided to revise their returns, arguing that the staking rewards were not income at that point and wanted to be refunded the tax already paid. So the IRS in the US eventually, they authorized the refund, and they said, okay, we're going to pay out your refund. I think the value of the refund was something like $3,000. So it wasn't significant. Interestingly enough, this couple decided to refuse the refund, and instead have taken this matter to the courts in order to get some sort of precedent set on staking income and tax implications of it. Obviously, these guys are doing massive amount of trades, and you can only imagine the value of their staking rewards. So you can see why legislation throughout the world is still not probably set in stone. taxpayers and people that are involved in significant trades are earning significant income, and they need kind of surety of how this is going to be taxed. So I thought this case is actually still on the go. There is no outcome, and it just gives us an understanding how one complex these things are, and two, how much value they add and how significant they are to taxpayers.
I think global trends are definitely going to affect or have an impact on the way our revenue service actually, what laws it potentially promulgates to be able to address various types of digital asset transaction scenarios.
Definitely, I think global trends will influence our legislation. Like we mentioned earlier, our legislation is actually kind of silent. There's not much guidance going on. If you look at just the websites of, I looked at the Australian Tax Office, we look at their website, they actually go into they give guidance on basically whatever we've discussed so far on cryptocurrencies. They give you what triggers the tax event, what is the tax consequences, etc. They go into cryptocurrencies, NFTs, airdrops, they discuss all of this. I think they're a bit more evolved. And then looking at it a bit more closely. And I think you're correct. We'll probably be influenced by the outcomes of those tax jurisdictions.
Okay. So let's go into NFTs. So from an NFT standpoint, just a couple of webinars back, we actually discussed, what NFTs are, but let's do just a bit of a quick recap. So an NFT is essentially, it's another form of a digital asset. It's a product of the blockchain, just like, email is a product of the internet. You're going to have various forms of digital assets. NFTs is now just sort of one of them. So it can come in the form of art, music, it could, gaming items, videos, right now, I mean, the sites are basically endless from an electronic type of file standpoint. They are bought and sold online, but frequently those types of transactions occur with payment occurs with cryptocurrency, although not exclusively. And they're encoded with the same type of underlying software as cryptocurrencies, because it is essentially products of the blockchain. Now, the NFTs as a market just recently took a massive dip. I think probably about 97% fall in terms of a global NFT market. I mean, whoever thought that purchasing an NFT or a digital file of a cartoon monkey would possibly hold its value, but I mean, stay tuned for that. It might actually rebound. But maybe we can talk a little bit about the NFTs transactions from a tax perspective.
Yeah, sure, Talin. Yeah, quite a big market, and which just recently crashed. But anyway, so I think firstly, the first thing to understand is that you have creators and then you have investors. So when a person creates an NFT to be sold, there typically wouldn't be any tax implication at the outset. Of course, when the creator sells the NFT, then the tax event will occur. So like you mentioned, NFTs are typically traded in cryptocurrencies. A person would give up or sell his cryptocurrency for an NFT. So for example, a person acquired an NFT for one Ethereum when the market value of that was, what the Ethereum coin was, $1,000. That person initially acquired the one Ethereum for 500 and therefore will realize a $500 gain on the disposal of one Ethereum, or gain on the NFT. Similarly, take the example of trading in NFTs. So a person purchases a Bored Ape NFT for one Ethereum when the market value of one Ethereum is $1,000. Assuming the market value of one Ethereum is still $1,000, this person then sells that NFT for 2 Ethereum and would therefore realize a profit of $1,000. So yes, if you maybe go to the next slide, interestingly enough, if you see at the bottom right-hand corner there, this picture is known as Every Day is the First 5,000 Days. And it's apparently the most expensive NFTs ever sold to one owner, and was sold for $69 million. Yeah, $69 million by an artist who goes by the name of People. So yes, there is values in NFT. They do have values. I mean, I'd urge you to go and maybe have a look at OpenSea and the Verb websites, and you'll find some interesting NFTs there. But definitely something we need to consider. It's becoming a big market. It might have taken a dip, but if you just go and look at the content on this website, there's so many things to buy. Some of them are like you say, the values are so minuscule. But who knows? You buy a picture of an ape today, in a year's time, who knows what it will be worth? So yeah, definitely a big market.
Well,
So
it's also being used for different things. I mean, now it's if we look at some of them, they're being used as you purchase them as part of sort of membership of exclusive type of communities. And that type of membership obviously would then either increase or possibly decrease in its value depending on scarcity. So I mean, your normal demand supply here would maybe trigger would affect the value of NFTs. I suppose with the added complication of or volatility in its valuation is the volatility associated with the cryptocurrencies that it's essentially valued in from that aspect. So it's not very simple. It's not necessarily that it's anything you purchase from an NFT standpoint is going to increase in value. It's much like any other type of investment decision. You need to be able to look at maybe the potential forecast or the potential for this for the value of a particular digital asset to increase, just like you would sort of purchase art, physical in its sort of physical form.
No, sure. Yeah, and again, also just to maybe just round out the discussion, NFT again, whether or not again the frequency of trade, how often you're trading in NFTs will depend, determine whether your gains you're making, all those things are revenue or capital in nature as well.
Okay. So the other aspect, aside from an income standpoint, is then also on the VAT side. So what sort of the VAT considerations that we need to be able to consider here from a crypto assets standpoint?
Yeah, okay. So in Section 2 of the VAT Act, which deals with financial services, so it deems the issue, acquisition, collection, buying or selling, or transfer of ownership of any cryptocurrency to be a financial service. So as financial services are exempt from VAT, transactions involved in cryptocurrencies would therefore not attract any VAT. But Section 210 of the VAT Act only refers to cryptocurrencies, right? And it is therefore unclear whether trades in other digital or crypto assets such as NFTs may attract VAT. Another point to consider specific to VAT and which should be applicable to foreign persons is whether the supply of crypto assets such as NFTs would fall within the VAT on foreign electronic services net. So while NFTs may not be a supply of any tangible goods or even a service, when considering the SARS FAQ guide on supplies of electronic services, SARS have indicated that electronic services refers to electronic or digital content that is supplied by electronic means, for example, via the internet or other telecommunication services. Items such as NFTs could therefore be brought into the to the FES net. So, but again, I haven't really seen anything come out on that, but just something to consider.
I suppose they would possibly be interpretation notes that would possibly maybe come out in the future to maybe clarify some of these situations as maybe more and more of these cases or case law actually originates, and possibly more from a local perspective as well.
100%. I think we do need more guidance on this.
Yeah.
I think it's just been kept a bit open-ended for specific reasons. Like you said, one, we're just waiting for, international influence to affect us, or maybe we're just looking to just get everything into the net at the moment. But it's a bit unclear. But SARS are, relying on the fact that they're saying normal rules apply, and that's what you're going to apply to determine your tax liability.
But I think this is just one of the situations where, even globally, we've always seen, and it's not just from a South African standpoint, but legislation and regulation has always had a problem catching up with technology. Which means legislators have to be able to understand the technology first in order to be able to regulate against it. So this is just one of the situations where that's occurring, and I think it's definitely going to mature. There's a lot that's maybe left up, I suppose up in the air. But I suppose as it stands right now, you would probably need to consider it on a case-by-case basis, based on those types of transactions. What would you consider? I think if we can just run through a summary, the key takeaways from today.
Yeah, so I think right at the onset, we mentioned that it's not cryptocurrencies are not legal tender, and because of that, there's kind of this misconception, and also adding to that it is a decentralized structure. So there's kind of this misconception that crypto assets are not taxable, or second for one, and then secondly, revenue authorities can't get information on me. So even if it is taxable, I don't see how revenue authorities can get information on my trades. That obviously is not true. So through what we've discussed, cryptocurrencies or crypto asset transactions are indeed taxable. And many of us would have noticed on our tax returns that they actually make provision for the disclosure of such transactions. You'll note the questions on the tax returns that refer to capital gains and losses specifically include that of crypto assets. Furthermore, tax authorities globally are evolving and introducing mechanisms and controls to monitor and source crypto information. For example, again, I go back to the Australian Tax Office. They have a crypto asset data matching program, which they state matches what you report in your tax return with data on crypto asset transaction accounts from designated service providers. And that apparently helps them identify buyers and sellers of crypto assets and quantify their transactions. So while SARS may not have such a program, well, not one that we know of actually, SARS have stated that they are granted a wide range of collection powers in terms of the Income Tax and Tax Administration Acts. And with time, we do expect SARS systems to evolve, and the exchange and retrieval of information would probably be seamless, So ultimately, the taxpayer bears the burden of proof and has an obligation to disclose crypto asset transactions. There are various tools and calculators where a person can track their crypto asset transactions for disclosure. And, ignorance would therefore not be an excuse for non-disclosure or inaccurate disclosure of taxable crypto trades.
Thanks, Oz. So I just want to thank you for today and explain to us, a couple of key things that we just need to be able to consider. As you've indicated, it's each scenario, needs to be looked at on its own merits. So if you're unclear, please reach out to our tax department for some, tailored advice as far as your cryptocurrency or digital asset trades are concerned and the tax impacts from that perspective. Thank you everybody for joining us today, and we look forward to our next webinar on digital assets as far as the accounting treatment is concerned on them. Thank you.